Hi everyone, happy new financial year. For many of you that have come into the meetings of late, you know that I'm only starting that 2022 starts now, as I would like to forget. I think we all would, the first 6 months of the year. It's been a shocker, but I want to just touch base on it because it has been a shocker and we can't hide from that. We can't run away from that. The one thing that we all know is that we talk about markets responding to certainty and uncertainty. Just before I came on to do this, I just wrote some notes as to the uncertainty that we've had over the last 6 months in terms of what could we have foreseen and what could we have not foreseen. So we look at it and we go through the Federal Reserve. They've got 400 PhDs that couldn't understand where inflation was at. So nobody knew. We all had a suspicion that interest rates, that inflation, the price of everything was going up, and we felt that maybe governments couldn't control it. That's now been confirmed, and that's why we're seeing the interest rates get hiked up, very aggressively, or you might hear on the news now it's very hawkish. That means they're being very aggressive. We've had inflation's an issue, we've had interest rates going up globally, we've had supply chain issues still on trying to get that sorted. There's been, if you remember a few years ago, there was problems with getting silicon chips in to get new cars. So all of these things are still ongoing issues. You've got COVID in China, we had Russia-Ukraine tension, you've just had overnight Boris Johnson is resigning as Prime Minister. So there's been a lot of uncertainty. So this has resulted in people obviously being very scared, and consequently it's been a rough 6 months for the share market and also investment markets of every regard. And if you want to put that into perspective, it was the worst 6 months the US share market has had since President Nixon was in office. So that's a long time since we've had this much uncertainty all rolled up into one 6 month period. So from our perspective, then we go back to the history books and we're thinking, well, what do we do? So for all of our clients, we know that diversification is a key principle. And I've got some slides here that I'm going to refer to that we're also going to put up that you can see, just to talk through it. So with the goal always being that you're going to have some peace of mind. I think also the other thing that we've been touching on of late is when markets go up 15%, all of us know that we're not then expecting that we're going to get a 30% return. We're not going to get another 15% return in the next 6 months. If markets go down 10% or 15 or 20%, it's highly unlikely that that's going to happen as well for the next 6 months. So on the upside, we're quite rational about it, but on the downside, sometimes we fear the worst. And with all the media and doom and gloom around, I don't blame you, but let's always keep things to perspective and know what happens in history. This is called the cycle of market emotions. You'll see it up on your screen, but what it refers to is going through the periods of where we worry, where we're optimistic, when we're elated, when we're overjoyed, and where our maximum points of financial loss are and our maximum points of financial return are. We all know that when the market's at its cheapest, that's its maximum point of financial return. But what's really interesting in this slide is you're going to go through five or six different market cycles, and each of them is going to take us through how we felt during that period, what the markets did, and how we felt. And it's a really great reference and a great tool, and something that we're going to talk a lot about in the next 6 months of the year with our clients to again help you pass that sleep at night test. So we don't want to be worrying about all of this if it's not worth worrying about. Our portfolios going down is worth worrying about, but we know that selling out is not the good idea, because then we put it in cash. We know the price of everything has gone up. So this is a different inflection point where the prices of all our goods and services are going up, what feels like 10%, but the prices and the values of all our assets are going down. So it's an unusual time. With regard to that, something that Centaur has always prided itself on is being on the same side of the table. With our clients, we know that this business doesn't get built without you, and we know that we don't continue without having you guys trust and support us and our relationship staying intact. From that perspective, although the price of most of the goods and services that we need to purchase have gone up around 5%, some 10%, we're not going to pass that cost on via a cost increase to you clients, because we know that what we've been saying to you is if you can draw less pension, that would be great. So we feel it's not the right thing to do to then increase our fee when we've got decreasing asset barriers and we're asking you guys to take a hit on some income. So we're going to do the same thing. And for our wealth accumulators, the view there is that you might need to put some of that money into your home loan because now interest rates have gone up. So from that perspective, we are always on the same side of the table as you guys. We thought this is an opportunity where we get to put our money where our mouth is. And so that was an easy decision for us to make. So hopefully we can work together to get through the next 6-12 months where there is this uncertainty. So the other factor that we're really thinking about is what is the outlook? How are we going to do going forward? We know interest rates are going up. We know that we're going to have inflation will eventually subdue. It seems like that's probably peaked now, even though in March the Federal Reserve said it's peaked. In May the Federal Reserve said it's peaked. Now though it does look, there are some indicators that generally look like it has peaked. So we're confident with that. What that will mean though, with interest rates going up, that will impact our company earnings on the equity share market side of things. But you all know that we have diversified portfolios. So the other side of the portfolio is the fixed income. This has really struggled for the past couple of years with low interest rates. But as that goes up, we can now allocate more of your portfolio into fixed income. So because interest rates have risen, you'll get a better return there, which means that we can wait out the share portfolio so that comes back into positive territory. It's our job to panic, not your job to panic. But I'm really confident in the next 6 months because I think a lot of the uncertainty that we had in the past 6 months won't be there in the next 6 months. And markets are always forward looking. So once we have a bit more certainty, I think we'll get a much better outcome in the back end of 2022. As always, if you have any worries though, call us, email us. We're always here for you. All right. Thank you very much. Bye.